It's finally Friday morning. Welcome back to Squawk Box. Budget carrier Tiger Airways has reported an increase in full-year earnings, turning the budget carrier around from a net loss the year before. That's even with the run-up in jet fuel prices as crude oil rose to record levels. Tiger has seen passenger numbers growing along with its seating capacity. It's also expanding its operations and recently launched Tiger Airways Australia. In fact, just this week, Tiger announced it was launching a second home base for its Australian operations. Tony Davis is the CEO at Tiger. He joins us now live on set and a first on CNBC interview. And staying with us is our guest host, Craig Russell, from Chief Market Strategist China at Saxo Bank, and also Ron Ianieri, Chief Options Strategist at the Options University. He's live out of Hong Kong. Tony, good morning. Yeah. Good to see you, and nice set of numbers. You must be happy.
Yeah, we're very happy. I think it's reinforced the fact that we have a very good model. It's a robust model. It's certainly attractive to people, particularly in difficult times like this we're seeing at the moment. People want low fares, and we believe we've got a model that can deliver those low fares.
Okay, describe it for us. I mean, what's so different about your model? Because you're a budget carrier in a space where oil or jet fuel accounts for up to half of your costs, yet you managed to turn around from a loss a year ago. How'd you do? Do you hedge?
We do hedge our forward oil requirements, but I think more importantly, we're very disciplined on our model. I mean, a lot of people can call themselves low-cost airlines or budget airlines. It's actually pretty hard to keep the discipline, to make sure that you look at every part of your cost base, make sure that you're stripping out anything that's not going to help you offer those low fares, and continue to be pure to the model. And I think that's what you're seeing at the moment is, you know, the people that are really disciplined on the model, people like Tiger, are delivering reasonable sets of numbers.
All right.
Others are not.
Okay, Sri?
Martin, thanks. Tony, good to see you. You broke into the domestic Australian market last November. How has performance been there? Has it met your expectations? And what part of the overall business do you expect Australia to contribute to in the future?
Well, I think it's fair to say that when we did the business plan for Tiger Airways Australia, oil was a lot lower than it is today. So, you know, we've been very careful in our expansion. I think what you see with Tiger is always a cautious approach to growth, but a committed approach to growth. And that's what we're doing in Australia. We're taking our time. It's certainly not a sprint. It's a marathon as far as we're concerned in building a sustainable business in Australia. But we're doing that very well. So I think in the coming year, Australia will account for roughly 2/3 of the passenger numbers for the group. Singapore will be about 1/3, Australia will be about 2/3. So it's going to be an important part of our business. But as I say, we're in no rush. We want to make sure we take our time, we build sustainable growth, we build profitable growth. And that's what I think the figures that we released yesterday show. We're very disciplined in that execution.
Ron, please join us.
Tony, pleasure to meet you, sir. Question for you. There's a lot of different airlines out there, and hedging is not something that's brand new. What are you doing hedging-wise that the other airlines, especially the airlines in the U.S., don't seem to be doing well? Is there anything in particular that you're doing differently than they are?
Well, I think we've got to be realistic. Hedging doesn't change the price of oil. It just smooths out the peaks and troughs. And certainly we don't rely on hedging to deliver the underlying cost base that we need to do to make sure that we have a profitable airline.
I got to ask you, Tony, you know, we've been talking about this earlier this week, and that is the risk that a lot of airlines that do hedge, and I think for a budget carrier a little bit unusual because it's usually the premium carriers that have more, can afford the more sophisticated hedging strategies. There's the risk that they could get caught locked in paying more for oil than it actually costs now. Is that a risk you face, or are you worried about that? Because you know, crude's come down from 147.70 down to, what is it, 118 right now, although avgas, I'm not sure if that's kept up.
Well, look, I think what we benefit from is a really strong board. I mean, if you look at the investors of Tiger Airways, we've got some of the biggest names in aviation as investors in the company, and they bring that experience into the boardroom. So our hedging strategy is well conceived. We believe it's appropriate for a company of our size, and it helps us smooth out those peaks and troughs. But the underlying business model has to be sound in its own right. Hedging doesn't in itself make the company more profitable or less profitable. It just smooths things out.
All right, fair enough. Tony, great to talk to you. Thanks for dropping by this morning.
Thanks a lot.
We've been talking to Tony Davis, the CEO at the budget carrier Tiger Airways, here on set with us in our first on CNBC interview.